At 9:42 a.m., somewhere in a glass building, a banker signs a routine agreement. No headlines, no cameras, no politicians arguing on television. Just a quiet signature between banks. But that small agreement quietly decides something very big. How expensive your life will be. Your mortgage, your student loan, your credit card, even the interest your savings earn. Most people think banks compete with each other, but behind the scenes, they cooperate. Not in a dramatic conspiracy, in something far more boring and far more powerful. A silent deal that keeps the entire financial system standing and quietly shapes your future. Let's start with a strange fact. Banks don't actually have as much money as you think. Take a large commercial bank. On paper, it might hold hundreds of billions of dollars in deposits. But that money isn't sitting in a giant vault. It's already gone. Loaned out as mortgages, business loans, car financing, government bonds. In reality, banks operate on a delicate balance. Money constantly flowing in, money constantly flowing out. Which means banks rely on something critical, other banks. Every single day, banks borrow money from each other. Not for years, not for months, sometimes for just one night. This is called the interbank lending market, and it is one of the most important financial systems most people have never heard of. Imagine Bank A ends the day slightly short of cash. Maybe customers withdrew more money than expected. Maybe a large payment cleared. Meanwhile, Bank B has extra cash sitting idle. Instead of panicking, Bank A simply borrows from Bank B overnight. Tomorrow, the loan is repaid with a tiny bit of interest. Simple, routine, invisible. But here's where the silent deal appears, because banks need a way to agree on what that interest rate should be. And when the biggest banks agree on a number, that number spreads everywhere. For decades, the world relied on something called LIBOR, the London Interbank Offered Rate. Every morning, a group of major global banks would answer a simple question. If you needed to borrow money today, what interest rate would you pay? Their answers were averaged together, and that number became the benchmark. LIBOR quietly controlled the price of money, not for a few loans, for trillions of dollars in contracts worldwide. Mortgages, corporate debt, student loans, derivatives. At its peak, LIBOR influenced more than $300 trillion in financial products. $300 trillion. To put that in perspective, the entire global economy produces roughly $100 trillion a year, which means a handful of banks were setting the reference number for something 3 times larger than the world economy, every day, quietly. And then something awkward happened. During the financial crisis of 2008, investigators noticed something strange. Banks weren't always reporting honest numbers. Some were reporting lower borrowing costs to look healthier than they actually were. Others were nudging the number slightly to profit from trades tied to LIBOR. A few basis points here, a tiny adjustment there. Individually, it looked harmless. Collectively, it moved billions. The scandal eventually exploded. Traders were prosecuted, banks paid massive fines, and regulators realized something uncomfortable. The price of global money had been resting on trust. Trust between banks, and trust turned out to be negotiable. So the system was redesigned. LIBOR was slowly retired. New benchmarks replaced it. In the United States, it's now SOFR, the Secured Overnight Financing Rate. Instead of asking banks what they think borrowing costs should be, SOFR looks at real transactions, actual loans happening in the overnight market. More transparent, more data, less guesswork, at least in theory. But here's the quiet irony. Even though the formula changed, the underlying structure didn't. Banks still depend on each other for daily liquidity. They still borrow overnight. They still move massive amounts of money through invisible pipes most people never see. The silent deal still exists. It just wears a different label. Because modern banking is less like a collection of separate institutions and more like a tightly connected network. Think of it as financial plumbing. If one pipe clogs, pressure builds everywhere. This is exactly what happened in 2008. Banks suddenly stopped trusting each other. Overnight lending froze, liquidity disappeared, and within weeks global finance looked like it might collapse, not because money vanished, but because the silent deal stopped working. When banks refuse to lend to each other, the entire system starts to seize up, which is why central banks now watch these markets obsessively. If overnight lending rates spike too high or liquidity dries up, they intervene, injecting cash, buying assets, acting as the lender of last resort. Because the truth is simple, modern economies run on confidence, and confidence between banks is the foundation. Which brings us back to you. Your mortgage rate, your credit card interest, your car loan, they don't start at your local bank branch. They start in these invisible markets where banks price money for each other. A few decimal points in the overnight market ripple outward, through lending desks, through financial contracts, through the entire credit system, eventually reaching your monthly payment. Most people imagine the financial system as something distant, a world of traders, skyscrapers, and complicated screens. But in reality, it's closer than that. Your future cost of living is quietly connected to deals happening between banks before the market even opens. And here's the strange part. The system works. Most days it works almost perfectly. Trillions move, loans settle, payments clear, nothing breaks, which is exactly why nobody notices it. Until something does break, until trust disappears, until the silent agreements stop being silent. Because when the quiet machinery behind money stalls, it doesn't stay hidden for long. It shows up in frozen credit, falling markets, and suddenly very expensive debt, the kind that reshapes economies and personal futures almost overnight. So the next time interest rates move, or mortgage payments suddenly rise, it might feel like a distant policy decision, a number announced by a central bank. But long before that announcement, long before the headlines, something else already happened. Banks quietly priced the cost of money between themselves, and the rest of the system simply followed. Which raises a question most people never think to ask. If the price of money starts with a handful of institutions lending to each other behind closed doors, how much of your financial future is really determined there, before you ever sign the loan?